Hey everybody, now that tax season is almost over, let's jump into the types of income that are not taxed by the IRS. This is always a popular topic, but this time I'm going to put a little spin on it. I'm going to make it more realistic. These are things that you can actually control. So let's start with what you can't control, right? Let's get some of this out of the way. You can't control things like workers' comp. You're not going to go just get hurt at work and get paid for the rest of your life tax free. No, 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 no. We're not going to talk about things like that. Disability insurance, employer education assistance, adoption. There's a whole slew of them. Even alimony nowadays, if you're receiving it, is tax free. So let's not talk about stuff like this. Okay, let's get to the things we can control. I want to work on things we can control. What can we do about our situation to be as efficient as possible? And some of that really, really means we have to understand the things that we can do to live tax free. So, if you're employed and you have access to health savings accounts, these are important. You should be saving money in there because you will be able to pay for medical expenses, medical related expenses that your insurance won't pay for. You're going to be able to use this money tax free. Nowadays, they've loosened up a lot of the rules. You can invest it properly. I've seen people going into retirement with big HSAs. So big being over $100,000. They can be very powerful. You can then invest that and start using all those profits to pay for all those medical expenses tax free. That's realistic. That's something you can do about it. If you have access to one of these HSAs, start using it. Next one, inheritance and gifts. If you've got more money than you need for yourself, a lot of people get confused about this annual exemption of $19,000. If you give 20,000, 30,000, 50,000, 700,000, 1.3 million, it doesn't matter. 19,000, you don't have to tell anybody, and nobody has to worry about any taxation. You can hand a check to anybody you want for 19,000 or less. You go over that 19,000, it simply reduces your lifetime exemption of 15 million. We don't have to worry about generation skipping taxes, gifting taxes, estate taxes till we go over a lifetime exemption of $15 million. So if you woke up and gave somebody $5 million, you're down to 10 million. That's it. That's all that happens. The receiver of the money doesn't have to pay taxes on it like it's income. It's not income. So we've got to, be proactive about things like this in a lot of people's cases. If you're pushing that $15 million, and again, that's per person. So if you're a married couple, that's 30 million between the two of you. But if you're pushing close to that 15 million, then maybe set up some gifting accounts and put 19,000 in every one of those accounts. And if you're married, that's right, that's 38,000 you can put in there. Every single year, put the money into those accounts. You're gifting it out of your estate. Okay? So tax free. Now, again, if you have wealthy parents and maybe you want to get some money from them, you could explain this one to them. Tax free income. Life insurance payouts. So, a few different ways to look at this. Some people, some kids, some heirs decide to pull out life insurance on their parents and pay for it and look at it as an investment. It's a little morbid of a way to invest, but in all reality, I've seen people do it. The proceeds are all completely tax free. Now, again, if you've woken up and realized you have more money than you need for yourself, one way that you can allocate some of your net worth is by allocating to permanent life insurance, passing to your heirs a chunk of completely tax-free money. Capital gains on your home. $250,000 exemption each. You can sell that home. You bought it for 500,000, you sold it for 750,000, you don't have to worry about taxation on that. Okay? So that's a nice little boost right there, tax-free income from selling your home. Municipal bond interest, that's an obvious one. You can choose to invest in municipal bonds in your after-tax part of your portfolio. This doesn't help anything in your Roth account. This doesn't help anything in your IRA, but your other money, your after-tax, your brokerage money, that's where you invest in municipal bonds. That kicks out tax-free interest. And if it's a municipal bond from the state that you live in, it could be double tax exempt from the state as well. Capital gains upon passing. This is an interesting one as well. You want to pass to heirs. We talked about life insurance as one way to pass tax-free to heirs. Well, guess what? All of your investments with capital gains have to be capital gains, and I'll define that. All your capital gains will step up upon one of you passing. Okay, so a few different things. When asset is inherited, the cost of the basis is stepped up to the fair market value at the date of the individual's death. The cost basis, let's say you bought something for $5 and it's now worth $100. Well, that cost basis steps up to the value when you passed, and nobody will owe those taxes on those gains when they turn around and sell it. So they're the heirs, the tax benefit. Heirs only pay capital gains on the appreciation that occurs after the owner's death. Okay, things like real estate, stocks, mutual funds, bonds, personal property are eligible. I even added a few more. I doubled up on this a little bit, but securities, business interests, any businesses that you own, collectibles, personal property, cryptocurrencies, NFTs, these are all things that have capital gains. Okay. So community property states, if you're in a community property state here in Arizona, we take advantage of this all the time. You want to make sure that you jointly own accounts that you can jointly own. You can't jointly own an IRA. You can't jointly own a Roth account, but everything else you should be able to jointly own. Those brokerage accounts you should jointly own if you're married. Okay, especially in these community property states, because guess what? If one of you passes, everything in that account steps up. Own your real estate jointly. And those are all really important things because that helps from an efficiency standpoint. Then you can sell and adjust the portfolio and not have any taxation on that. Properly taking advantage of this is very important. It changes how you invest in that after-tax portfolio. Some Social Security is not taxed. Well, first of all, everybody gets 15% of their Social Security tax-free. Yay! When I started advising, it was the World War II generation that was very disgruntled about the fact that they had to pay taxes on their Social Security. But the reality is now that's so long lost. It's exciting. We don't have to pay taxes on 15% of your Social Security. Well, for some people living on low incomes, believe it or not, some of their or all of their Social Security might not be taxable income. So this is something that we can control. They give us some estimations on ways to calculate this because the IRS has like a 2 or 3 page worksheet to figure out how much of your Social Security is taxable. If you add up half your Social Security plus all other forms of income, including those municipal bonds, those tax-free interest, add up all other forms of income, and then you go see this chart, you'll kind of figure out a roundabout where the amount of Social Security that will be taxable. So if the number for a married couple is under 32, single under 25, no part of your Social Security gets taxed. It's kind of nice. But you got to manage that situation. I've met people that are living in that range, but have a couple extra expenses, and one year they pull some extra money out of their IRA, and all of a sudden it jumps, and they owe thousands in taxes because their Social Security became taxable. So it's a very sensitive part of our tax return. You got to be careful, but it can be tax-free income. Another one, look at just in general, our standard deductions are so big now. So the standard deduction maxed out all the options with the new $6,000 bonus deduction for being over 65. For a single person is $24,000. For a married couple, it's $47,500. Okay, we're almost pushing 50 grand. Next year or two, this is going to be over 50 grand. The reality is you add up all of these. Not all of your Social Security is taxable. Maybe you got some municipal bond interest. Maybe you got some Roth accounts. Maybe you've got all this stuff going on. So you've got pretty good income. I've seen married couples with 70-ish thousand dollars worth of income living completely tax-free. There's another form coming up here. I got two more. I got 10. I got two more forms. The reality is we can actually have a reasonable income and be completely tax-free, especially when every penny is ours. The funny thing is I usually, for a lot of retired couples, pushing up to the top of the 12% tax bracket becomes really important. And they say, well, what if I want more income? Well, there's lots of ways to generate additional income that is not subject to that high taxation. Well, the same thing here. Understand when you're subject to that higher taxation, that forces you to pull even more and have more taxable income. And it's just this slippery slope that just seems to get worse and worse and worse and worse. So the more income you have, the more of it that goes to taxation. When you live efficiently, you can have some decent income and pay no taxes. Every dollar goes into your pocket and stays there. The next one, there's your Roth IRA. That's self-explanatory. I have a whole class on Roth if you don't know enough about Roth. Roth is wonderful if you use it properly. There's too many people that don't use it properly. I have a whole class on it at sesweb.net, right here. You can jump on there and find all of our classes. Our full form, they're hour long typically. Roth is fantastic when used properly, can generate tax-free income, and it doesn't affect the taxation of Social Security yet either. And the last one, okay, this is one, if managed properly, is a fantastic part of retirees' portfolios. A lot of retirees can take advantage of tax-free long-term capital gains and qualified dividends. Okay, when we max out all of these standard deductions that I just talked about, single people 16,000 plus 65 and blind another 2,000 plus another 65 for the bonus deduction, or 6,000 for the bonus deduction, married couples, so forth and so on. It is amazing how much we get in free income. But then you go to the capital gains and qualified dividends tax brackets, you add those in, and we've got $72,000 worth of income and 144 for married couples before we have to worry about paying taxes on long-term capital gains and qualified dividends. Now, the trick of this is understanding that this is total income. Okay, this includes all of your ordinary income, your Social Security check, your pension check, W-2s, whatever income that you have. If it's all below this, including your dividends and long-term capital gains, it's zero taxation. So quite often, especially for married couples, I run into this all the time. Maybe they've got 50, 60, 75, 80, $100,000 worth of income between Social Security and pension income, things like that. Well, then we can generate dividend income that comes out completely tax-free. That's wonderful. And that's something we use all the time in retirement portfolios, just trying to be as efficient as we can be. So there's lots of wonderful opportunities. When managing this stuff properly, you certainly can live in a tax-free world, even in a realistic way. A lot of people bend over backwards. They just shove all their money in Roth. See, I'm tax-free. Woo! Yeah, but you paid 32% taxes just to get that into Roth. Doesn't make any sense. Let's do this more realistically. And this stuff, all of these things, to one part or another, can apply to a real person's life on an everyday basis. These dividends, when managed properly. That's why I always talk about having the right investments in the right parts of your portfolio. So if I can help in any way, certainly you can visit yourinvestmentcounselor.com and schedule an appointment with me, or you could even give us a call, 800-345-3155. Free meet and greets. I jump on Zoom all the time, or if you're lucky, you're here in Arizona in this wonderful non-summer weather and enjoying this this place, come on by. You can always meet us in our office. Nonprofit classes, we do full hour-long classes, fpfeaz.org. Jump on there, visit our company's website, sesweb.net as well. All right, everybody, subscribe. I got new videos all the time going on here. We've got over 300 videos, 16,000 subscribers, lots of great stuff. And I try to talk about anything and everything as it relates to finances in retirement. Thanks for joining us. Smash that like button, and we'll see you next week. Thanks again, everybody. Bye now.